third time in a row, as Arpita said. So good. Would like to talk about, takeover from where Arpita left, some amount of overlap in terms of what's been happening. We've had a great foundation for the industry, and we look forward to a solid future. So let me talk to you a bit about the global trends, very briefly, and then go to what's happening domestically. Just very quickly, let's start off with what's happening on the global front. Arpita did mention, over the last very many years, 12-ish years, industry has been growing at more than twice the rate of what the conventional assets has been. Last year, as I understand it, it was 8%, very, very solid growth. Continues to outperform the conventional assets very, very handsomely. At this point in time, if I recollect the numbers correctly, it's about 15 to 16% of the overall asset space. So traditionals are 80 plus or 80, 85, and the non-traditionals are about 15. But I think the most important thing which you need to bear in mind here is not just in terms of the size of the asset pool, right, or the percentage of the asset pool, is the profitability. So when you look at profitability potential, again, I'm quoting some statistics, it's about, if I'm not mistaken, in the vicinity of 30-ish%, and this excludes performance-linked fee. So if you get that throwing in, then from a profitability perspective, this is something which is extremely attractive to investors. So that's one thing which I would leave with you. Growth, again, has been really, like we said, really strong. A lot of it come in from three categories. The pension funds, they are the largest investors. The offshore funds, the pension funds, the sovereign funds, and of course HNIs. Now, that's very interesting. Arpita did mention about it, but it's very, very key that this is complete opposite of what is in India. In India, it is entirely an HNI-dominated market. And only now that you've had the first stirrings, the first very few stirrings of offshore investments, rather of institutional investments. You had something from insurance companies. You had something which is coming in from, let us say now you would have some, or we hope to have a lot coming in from the offshore fund. So that's the other point which I want to leave with you as far as the offshore market is concerned. Okay, I think with that, I'll move to what's happening on the domestic front. Okay, incidentally, again, there is a strong growth which is expected out there in the next few years for offshore investors, right? Sorry, for the global markets. Aditya, you done? Okay, right. It's getting more difficult to rely on my memory, but let me try. Okay, so okay, good. Let me just quickly come into what's happening domestically. Let's come to quickly what's happening domestically. So domestically, 3 years, and if you look at the report card post 3 years, I think it's been a splendid 3 years. I mean, you look at the growth we've had, 25,000 crores of commitment, which is a splendid number. 158 funds. It's not just the 158 funds. With that, I'll leave 2 points with you. Point number one is that if you look at the range of funds, so you've got everything from, today you have real estate funds really dominate, possibly, in category 2. You had infrastructure funds, you've got film funds, you've got a social responsibility fund, there are 4 film funds. Just think of it. So there's so much which is out there. It's such a widespread, which is quite incredible, right? So first, number one. Number two is when you look at the spread, again, and this is very important, is that you've got, it's not just encouraging the large investors. So you've got large asset managers, you've got, all the big brands out there, and you also have a lot of the, let us call it the boutique managers. And there are so many boutique managers out there. Who are making a mark very much in all categories, more so in category 3. So while maybe category 2 and category 1 are more dominated by the larger players, category 3, there are a lot of guys doing extremely well in that. And that's something which is noteworthy, which also speaks volumes for the regulations, because obviously if you've had a regulation which has encouraged so much of business, number one, and two, then within that, you've actually managed to keep a forum both for the, let's put it, for the larger investors as well as for the smaller investors. Just before coming to the local market, I think one of the most important things which we really want to talk about is the fact that the need for alternatives. One of the key things which is out here in terms of the alternatives that equity, when you look at the need for alternatives in the local context, Equity market is flattish over the last 1 year. You really have not returned too much over the last 1 year. Last 3-ish year, 10% growth. Currently, when you look at investment grade credit, anything on the investment grade credit is clearly sub 8.5, right? And this is pre-tax. So when you're looking on a post-tax basis, that's obviously a lot lower. So now when you're talking about anything which can deliver an extent of absolute return with fairly good, let's say an extent of absolute return, as well as outperformance, should do pretty well in this environment, right? Interest rates heading down, interest rates clearly heading down. Equity markets, while we are very positive, likely to move very much in line with, let's say with earnings growth or long-term trends, which would be in the 15-16% vicinity. So longer term, you clearly a case for alternatives to do very well, right? So that's the domestic scenario. I mentioned to you about what's happening in terms of the industry, key trends, a lot of players, a lot of participation across all different categories of players, large, small, different types of funds, different guys already making the niches, so that's great. Again, in terms of what's happening out there is that when you look at your different categories of growth very quickly, it's not important. Last year, the industry grew by 85%. Category 1, 2, and 3. So category 1 grew by 40%, 2 by 130%, and 3 by 34%, right? But category 3, on account of various reasons, primarily to do with tax to our mind, has really been, what could have been the star in terms of a category of growth has been lagging behind. I would like to believe that over a period of time, that clearly that anomaly should be addressed, and category 3 would probably have a lot more of potential. One very clear challenge, which I see, and I think we guys need to be aware of this, is because most of what one operates in category 1 and 2 is in the illiquid asset category, right? You look at it, it's all illiquid assets, it's not liquid assets. The biggest challenge is deployment. The biggest challenge is deployment. So when you look at the numbers, and there are some numbers out there, and I'd invite you to look at the presentation later. When you look at those numbers, you would clearly see one thing. The ability to deploy is clearly a challenge. And deployment is currently running at anything like 40 to 50% of actual commitment, which in another way tells you that there's a lot of appetite out there if you could get that money deployed. And if you can get that money deployed, you'll probably get a lot more commitment. So just bear in mind, in the your liquid assets really in this country are typically your large nifty stocks and maybe government securities. Beyond that, everything is rather illiquid. This is the illiquid space, and this is a very big challenge. Investors you've got commitments, unable to draw down, unable to deploy. That's one of the biggest challenges today facing investors. Just move on there from that one. So category 2 dominates, category 3 coming into its end. The other very important thing which I'll leave with you guys again is that debt continues to dominate. Look at it this way. When you're looking, it's most of the funds are some version of debt. Either it's in the infra space, it's in category 2. You look at it, the bulk of it is not private equity, it's private debt. Category 3 is of course different because you're in the listed exchange traded market. So category 3 is quite different, but category 2 is quite different, right? Another issue which we've seen, or another thing come up, another trend, and actually it's possibly too early to see it a trend, but I believe that will play out, is that the situation of tie-ups. So you've had at least a couple of cases of small managers with very good strategies and at least a good track record of delivery in the short time they've been in the AIF space as well as in the PMS space, have actually gone and tied up or been acquired by larger players. And I think those who can bring brand, those who can bring distribution. And I think that's a very interesting trend because you're really looking at a larger player acknowledging that they don't have maybe the skill set or the ability to manufacture, so to speak, or from an investment perspective, but at the same time, they have the brand, the distribution, and the reach. Wonderful marriage. I am sure you'll see a lot more of that coming in because you'll have a lot of smart guys with good strategies, but unable to have maybe the brand, the reach, the entire infrastructure, and I think that's a trend you will have going forward. Two very interesting things which have happened is, of course, the pass-through to category 2, to category 1 and category 2, which has happened, and that's really been a very interesting trend. A couple of trends which I think are pointers which I think also are very interesting, something which happened about 2 weeks ago. RBI has now permitted offshore investors to invest directly into AIFs. What this effectively means is the following, that an offshore investor can invest, come directly into an AIF, and he effectively comes in as a local investor. In some categories, example in real estate, that's really a game changer, because what one could not participate in different manners can now come in directly. SEBI had earlier, of course, permitted offshore investors to come into the AIF, and now with the RBI notification, I think this has become a reality. This, to my mind, will be one of the game changers. Very, very important, and I think this will change the market very, very significantly. The other thing is, over the last 1 year, in certain categories of funds, you've seen a significant participation, or I would say starting of a participation from insurance companies. And a lot of funds have been almost entirely fund subscribed in category 1, and limited in category 2 have almost been entirely subscribed by insurance companies. I think that's a big trend, because that's another pool of capital which is out there, which could really have you. The last point which I'll mention here, which has really nothing to do with alternate assets, nothing directly to do with alternate assets, but indirectly is very important. All of you may know that a few months ago, EPFO for the first time, EPFO is Employees Provident Fund Scheme, permitted equity investment. This is, of course, the index funds and equity investments into the EPFO. I don't know how many of us realize, but to our mind, that's one of the most game-changing events which has ever happened in this country, right? And if, let us say, the experience is satisfactory and if the trend continues, you could also have a potential, and I'm not saying today, and this is very, very early days, but if they can look at equity and in a very progressive manner, there is nothing that certain categories of AIF, I'm not saying all categories, might be considered maybe 3 years, 5 years, 7 years, 10 years from today. And then think of the sort of pools of money which could potentially be available. So one of the trends which we said that this is a primarily HNI dominated space, you could have greater institutional participation. You've seen that happening. Now you could have it from offshore investors, you could have it from domestic, let us say, insurance-like institutions, and you could, potentially going forward at some stage. That's a long, long way off, maybe by, maybe from even the pension funds and so on. Okay, I think the credit for all of this goes to SEBI. SEBI has really put forward, I would say, extremely progressive regulations at the very outset. Those regulations give you enough scope to everyone for operating. There's enough scope for everyone to operate. There are enough categories who can actually, come into play. Every category can do virtually very well for themselves. Wide coverage, adequate scope, unconventional players, enough of flexibility at the same time. That is from the perspective of, so to speak, the market participants. But most important, from a investee's perspective, I think it's well regulated. The regulations are in a progressive manner and in a gradual manner also being, let us say, tightened. You've seen that happen all through last year. A slide here gives you some of that. So, excellent regulations. They've got things like skin in the game and so on and so forth, which I have not seen anyone saying that if they address this, the industry could go that much further. It's so wide, it's so good. And if we have certain more help, so to speak, from a taxation perspective, right? I think that would really put the industry, especially category 3 more, into another orbit. Okay, coming towards the end of whatever I have to say. So what's determined success so far? So we've looked at a few guys. I think the other important thing, and this is a good trend, that almost everyone in their little way has been reasonably successful. So you look at most participants, they've been reasonably successful in raising and deploying some amount of money, which is a great trend. But some have been maybe a little more successful than others, and possibly we've just thought of about 4 characteristics of participants which might have done it. One is, of course, investment performance. I know 3 years is a short period, but within that 3 years, what one could have done or within that period. And 2, a lot of them come with maybe a track record on a previous platform. It could have been a VC platform, it could have been a PMS platform. So, that obviously in a sense gets ported. So how do people look at that? So anyone with a good track record, obviously, which is an obvious statement, it helps. Some players we've seen with lack of track record, lack of any experience in a particular space too, on account of a strong brand, have managed to raise a fair amount of money, which is again, conventional thing, strong financial brand, people extend it into a certain category, done well. Some strategies are quite differentiated, very, very different from what may have been done in the past. And those guys have actually attracted a fair amount of money in a market starved of ideas. That's really worked. And some, like in many cases, NBFCs, where they may have launched their own AIF, so to speak, they've leveraged off the parent strength. So you've seen all of it. Investment performance, brand, differentiated strategies, and then either leveraging of your parents, very blatantly leveraging of your parent strength is really been some of the reasons for success. My last couple of points out here. So what's the challenges going forward? Clearly, to my mind, challenge number one continues to be appropriate deployment and appropriate returns what one can give to investors. Because we've seen that fundraising is running ahead, so to speak, to my mind at least, ahead of deployment and actual delivery. And I think that over the long term will be one of the key determinants of how the investors will finally see this space. Investment management, a lot of strategies are being launched. Very little track record of performance, very little track record of risks. So as that comes in and as the skill sets evolve from an investment management perspective, I think that needs to evolve, and that will evolve along the way. The other trend I see, which is really quite unfortunate, is and that's of course from a selfish investment manager's perspective, is that pricing has been quite subdued. To a lot of us who might have thought that this might be a profitable stream, I have almost seen some amount of irrational pricing. It's unfortunate because I think the only way to compete is not price. It can be a lot more value added to investors and so on and so forth. And I think people are doing, but that's one of the trends we've seen, which is it's just people competing on price, and that's, I think longer term it will impact the margins of the industry, ability to attract talent, retain talent, and so on and so forth. So that's something which is clearly happening. The other one is that a lot of small things which are changing. Along the way, last year let us say the approach towards taxation changed from a taxation at the AIF level to a pool level. Now, for example, that has put a lot of when you look at taxation and when you look at reporting to investors, that's really caused a lot of small little challenges. So I'm not focusing on that, but I'm saying there are a lot of niggling things which need to get out of the way, which I'm sure will always be there in the growth of an industry. But once we get those things out of the way, I think we'll be set for a long, long more, right? I think so. What do we really need to do to take us ahead? I think more with the mindset of, rather than, I would put it this way, that what value we can deliver to our investors, what we can actually generate in an environment where returns are hard to come by. On the debt side, on an investment grade, you can't get more than 5 today, 5.5. It's very, very difficult post-tax, sorry, to see that happen. So if you can just think of the pools of money which are available, if on a sustained basis you could, if you believe you can deliver something out there, right? Same on the equity side, if you can deliver fairly consistently, like some category 3 funds endeavor to do, look at the pools of money which are potentially available, which could be there. I think the most important thing in investment management, of course, is, and in client interface, is actually managing client expectations, is actually interacting with your client, managing expectations, selling appropriately, disclosing appropriately, and so on. I would say in some ways it's more challenging than even the investment management part. And that's something which needs to evolve along the way, because a lot of this is different, a lot of it is esoteric. Accounting is different, it's very, very different. People say, I thought this is the way it would be in a mutual fund, but this is not the way it works for various reasons. Those things are something which we will and address along the way. So in conclusion, I think the industry has made a very promising business, beginning, very, very promising beginning. If you look at the size, it's possibly one of the best starts of any industry has had in this country. There's a lot of interest, a lot of commitment from all parties. It's great because it's been great for, you've had a very wide spread, large players, small players, all participants coming in, great response from, from wealth managers, some interesting response from institutional investors. So lots needs to be put in place, delivery in terms of what you commit, investor education, so on. Finally, I think your next big leap to our mind is going to be over the next some time, to an extent, from the local perspective, is more a bit about the institutionalization of this market. And I'm not saying just from an investment management side. I think there'll be continue to be boutiques. I think more institutionalization from a perspective of more, I would call it institutional players and offshore players participating. I think by the next year, that would be the big leap, if you can manage to get your deployment right. So that, to our mind, continues to be the biggest challenge. I think pretty much, so with all the regulatory support we've got, with all the overall, I would call it support from now the RBI and hopefully from tax authorities too in the future, I think we've had a great start and look forward to a very, very promising future in the next very many years. I probably have a few minutes for questions, so maybe 5 minutes. If there's any question anyone would like to ask. Yes, sir. Right.
Not still doing, I mean, they're at a compliance stage for approvals.
Right. Correct.
How much time do you think it might take in terms of approvals?
Okay, so difficult to say. See, anything has come in, there's a lot which needs to be worked out. This is the first time we've done it. Now, I'm speaking for ourselves. We, for one, for example, have at this stage, let's put it this way, done our own homework, employed our consultant, got our draft process flow out in, we believe from sometime next week, we should be in a position to start taking money. But, everybody would be at a different stage. There would be a different process. But I think even if you leave next week for a minute, it could be next month for some, but it will be sooner than later. Because to our mind, other than some operational issues to be, or technical maybe issues on the ground to be raised out, there's nothing from a regulatory or a policy perspective which now comes in the way. So hopefully those are more procedural matters which get addressed, I suspect very soon.
Thank you.
Very, very soon. Yeah. Sorry.
So over here we are seeing HNI participating more compared to what's the global trend. Why is this global trend versus domestic trend so different? That's one.
Sorry.
And the second question I have is, you talked about the challenge on deployment. So how are we addressing that challenge?
Okay. See, the first one, I really wouldn't, the industry is itself 3 years old. So I think we have to be fair to everybody out here. We need to give it a little more time. The life of most industries is a long thing, is very, very long. So I suspect that will do. See, it's got more to do, to my mind, the regulations of the respective sector, right? So when you look at the regulations of the respective sector, i.e., let's put it this way, when you look at the regulations of, let's call it insurance companies, there are still some regulations which may not permit them to invest in certain categories of AIFs. If that gets sorted out, then they can. So I think it's more to do with the respective regulations and the respective, see, it's a progression. It's like on day one, nobody's going to jump into alternate assets. It's like, you first take care of the basic needs and then it will come. So like we said, like I mentioned in the case of EPFO, in case of equity, right? It's a trend. It took many years, but you've come there. So it's a period of time. I think it's more to do with regulatory and mindset, and that will come. As far as the second thing is concerned, honestly, that's a very difficult one, and each guy has to have their own answer in terms of that would distinguish investment teams for the other. One is, of course, what good job you do once you've raised the money to deploy it. The other one would be, because we've seen in the space we operate, some investment managers who just have taken money 2 years ago and still have no ability to deploy it. Some guys are doing better. So it then comes the skill set, the ability of that respective investment team. And that is one of the factors which, to my mind, will differentiate, some quality of manager, of investment manager versus the other. But as an industry, I'm not really sure. You can't fast forward something. It's a process. It goes through that process, and then that's the way it will work. Yeah. Sorry, go ahead.
Hi, Shahzad, how are you? So just a related question to excess funds chasing lesser good assets out there. Do you see IRRs kind of falling? Do you see portfolio managers actually taking more riskier bets these days than what they were doing probably a couple of years back?
Okay, yeah, I guess what you're saying is interesting. See, first, overall returns overall in a market are trending down. There's no doubt about that. So whether you look at any class of securities overall, I'm not referring to equity here, but more on the, call it the debt, structured debt space, the returns are, which I guess is what you're alluding to, structured debt, returns are sort of are trending down. In terms of more risky, yes, there is more money, there are new managers, and that's what I was referring to, very little track record. मैंने नया fund launch किया, मेरे को कुछ लगाना है, I don't have the skill set, and you're going to get mishaps and you're going to get mistakes, which unfortunately in this business is an illiquid asset, right? And it is going to take you many years to find out, right? But hopefully, as the industry evolves, you'll make less and less. You look at the progression of any industry, whether it was, let's say, the mutual fund industry, a lot of things which maybe shouldn't have happened in 93, 95. But if you look at the industry today, it's completely a different and a much more evolved industry. So I guess we'll have to live through that. That's the only way. And that will distinguish one class of investment managers vis-a-vis the others, maybe. Good. I guess with that, I should not eat into the next participant's time. Thank you very much for this. My apologies. I don't know why this has not worked, but we'll try to get this across to all of you. I hope you read it, and it will probably make a lot of sense to you. Thank you so much. Take care. Bye-bye.